The stock market went as low as negative 1.9% in the beginning of trading today. This is very straightforward. It is because the markets were pricing in a 1% rate hike for the next upcoming Fed meeting. It was also because bank earnings were very bad. The yield curve is inverted in a massive way, and PPI, Producer Price Index, a measure of wholesale producer side of inflation, well, it almost hit a new all-time high. Yes, it is ticking back up again. So that's pretty straightforward. But what actually happened and why the market started to rally is because now a 1% rate hike is no longer priced into the markets. So we're going to get into all of this information. We actually had Fed Wallard that came out and spoke today, and what he said was very interesting. So he said, markets are getting too far ahead of themselves, pricing in a 1% rate hike based off of just one data point. He went on to say that at the next meeting, his base case for his vote, at least, is a 75 basis point rate hike. He was then asked, what would make you do a 1% rate hike? He said if specifically retail sales that come out tomorrow were to show that the consumer is still healthy and spending money, then he would be open to that 1% rate hike. And he also said that a recession is plausibly avoidable. He was literally speaking to the markets what they wanted to hear. That caused the Fed futures to go from 80% probability of a 1% rate hike now down to less than 50% of a 1% rate hike. So that is what gave us the midday market bounce. It's literally as simple as that. The probability of a 1% rate hike as of yesterday was 82.7%. Now it is 39.8%. But what this is really telling markets is there is a wide divergence between Fed speakers. Some Fed speakers are going to think, hey, we need a 1% rate hike. Some Fed speakers are going to say, yeah, maybe not. Fed Wallard also did make it a big point to essentially point out to the markets that a 75 basis point rate hike is 3 normal rate hikes in one, that they are doing their job. They are raising rates very, very aggressively, quite honestly unprecedented. We have not seen them raise rates 75 basis points, which is probably what they're going to do over the next couple of meetings since the 80s. The Fed is doing what they need to do. That's what Fed Wallard reiterated, but he also made sure to point out that it is going to revolve around data. And what data we get tomorrow is retail sales, month over month for June. He also pointed out that last month's retail sales were very, very bad, negative 0.3% month over month. This next month for June, we're expecting a 0.5% increase. So if we get a 0.5% increase, if retail sales come in possibly better than even a 0.5%, which I find hard to believe. We'll see what the number comes out as. I think we're probably going to miss in a big way. But if this number comes in really good, that could actually be a negative thing for the markets because we will price in that 1% rate hike again. So that's very important. We also do have Fed Bostic that speaks tomorrow at 8:45 in the morning, 15 minutes after retail sales does come out. And I think the Fed speakers are really going to dominate how the markets move until the next Fed meeting, which is obviously July 27th at 2 p.m., 1 week, 6 days, and 17 minutes away, because it will move around the odds of a 1% rate hike. If Fed speakers seem like they are on board with 1% rate hike, well, we're going to start pricing that in, and that is going to, as well as just drive up interest rates, it's going to push us into a recession, which is likely what the Fed wants. The Fed probably wants us to go into a slight recession so we get the benefits of a recession. Hear me out here. It's very bad to say that, and I don't wish we go into recession, but when you go into a recession, you experience deflation. You experience the Fed potentially cutting rates. Usually they cut rates. Only a few select instances in our history has the Fed actually raised rates during a recession, and that was during the Volcker time period. And that was obviously a whole different can of worms we're not going to get into here in this video. But that would be a positive thing, at least for the side of inflation. At that point, once we go into recession, we're not going to be concerned about, like I said, inflation. We're not going to be concerned about the Fed raising rates anymore. But what we will be concerned about is, are stocks at fair valuations? How bad will this recession be? For an example, is Apple's revenue earnings going to drop 20%, or are they going to drop 50%? Do people just stop buying things, or is it just a Wall Street technical paper recession and it's not quite what we hope for, right, for 2022 2023 earnings, but it's not that bad, and potentially maybe stocks are undervalued in that case? Only time will tell, but that's the current situation that we are being faced with. So retail sales coming out tomorrow will be very, very important. You do also have the Michigan Consumer Sentiment Preliminary Survey for July, and this is also important because it'll give us inflation expectations. It will give us the state of the consumer, what our expectations for, do you think you're going to be in a better financial situation a year from now? Do you think you're going to be in a worse situation? Do you think you could potentially lose your job? We're going to get a lot of insights from the consumer, and that will be big for the stock market because that will directly play into how much growth we are expecting to see, or potentially how bad a recession could be, how bad consumers are starting to pull back. So those are going to be the three main things for tomorrow, and that will wrap up this trading week. And depending on what happens with the Fed futures, that is probably going to dictate the markets. And you've seen a sharp drop off here today, and usually that would give us a very bullish reaction in the markets. We're starting to see that climb up again, but bank earnings were terrible. And specifically what happened with JP Morgan was really, really bad. So Morgan Stanley, they missed. Their revenue came in at $13.13 billion versus $13.48 billion that was expected. Earnings per share really missed, coming in at $1.39 per share, expecting $1.53 per share. JP Morgan, on the other hand, it's really bad. JP Morgan Chase earnings fell 28% after building reserves for bad loans. Bank suspends buybacks. Shares of the bank fell nearly 5% in trading Thursday, hitting a fresh 52-week low. Chairman and CEO Jamie Dimon warned geopolitical tension, high inflation, and waning consumer confidence could hurt the economy, quote, sometime down the line. He says, but with, and this is the full statement. I just read the key points, but we're going to read this and this paragraph because what is said in here is very telling, and you definitely want to pay attention to it. He says, but geopolitical tension, high inflation, waning consumer confidence, the uncertainty about how high rates have to go, and the never before seen quantitative tightening and their effects on global liquidity. Quantitative tightening means running off the balance sheet, reducing the Fed's balance sheet, combined with the war in Ukraine and its harmful effects on global energy and food prices, are very likely to have negative consequences on the global economy sometime down the road, he warned. With this outlook, JP Morgan has opted to temporarily suspend its share repurchases to help it reach regulatory capital requirements, a prospect feared by analysts earlier this year. Last month, the bank was forced to keep its dividend unchanged while rivals boosted their payouts. Now, what this is, there was a bank stress test that happens every single year, and it gives, I believe it's a 55% decline in the stock market. It's a 15% unemployment rate. It's like a $600 billion of total losses combined with all these banks, and it basically gives a fake scenario, and it says, hey, will you be able to survive? And JP Morgan, well, they all passed. All the banks passed. But depending on how these banks did during their test, they have to put up more collateral or potentially could release collateral. For an example, last year, JP Morgan was able to release $3 billion worth of collateral. Well, this year, JP Morgan unable to raise its dividend, and they actually have to put more money in for loan loss provisions. JP Morgan just this second quarter added $428 million to its loan loss provision program. pretty much as simple as it sounds. They put money up in case people start to default on loans, so they will be okay. Not a good sign. Not a good sign for potentially what kind of loans they have, what their balance sheet looks like. And we're just going to leave it at that. Morgan Stanley as well, profits declined about 30%. That doesn't give us as much of a glimpse into the consumer, though. That's more of a Wall Street bank, so that's kind of why I didn't cover their earnings as much. But bank earnings were the topic of discussion as of today. So what else is happening here in the markets? Well, the yield curve is still inverted, and it did invert to record levels that we have not seen, a low of a 0.25%, 0.25% inverted as of earlier today. Now it's only inverted by 0.17%. So the best way to look at this, and we're, like I said, we're going to keep this really Econ 101. Imagine this like a dividend stock. This will make you so much money in your investment lifetime if you just learn how bonds trade and what they mean relative to equities, because the bond market is much larger than the stock market. So depending on what happens in the bond market, bond markets tend to be correct. So as you guys know, when the 2 and 10 year yield curve does invert, that is a sign of a recession. Well, what does an inverted yield curve actually mean? It means that if you bought a 2-year bond, you would get paid out more than a 10-year bond. That should never happen. Deeper it inverts, the worse the problem is, the worse the situation is. This thing started to slowly get closer to inverting ever since mid-October of 2021. So what is this? Like I just said, think about this like a dividend stock. It works the exact same way. The actual dollar amount is fixed with bonds. It does not fluctuate like a dividend stock, but it works the same way. For an example, if you got paid out 5% on a $100 dividend stock, great, you're making 5%, awesome. But what if a lot of people start to sell that dividend stock, and let's say the stock drops to $50 and it's still paying out essentially $5 a year, 5%. Well, now it dropped 50%, so now it pays out 10%, right? Are you guys catching my drift here? So in the bond markets, when bond yields are going up for a 2-year treasury, investors are actually selling 2-year bonds because they expect rates to go up in the short term in a massive way. But what do they expect for the 10-year? If the 10-year rate is actually going down, the 10-year bond over here on CNBC, we'll go ahead and point it up, it's went down. That means investors are expecting, and it's only at 2.96%. That means investors are expecting that the Fed will have to cut rates a lot sooner than what we previously expected. The 10-year treasury hit a high of 3.5% back here on June 14th after we got the last two CPI readings ago. So it's essentially saying, hey, we're going into recession, but the Fed is going to make a mistake. They're going to raise rates so aggressive, they're going to push us into recession that they will not only have to stop raising rates, but they will also have to cut rates before 10 years is up. So if you're buying a 10-year treasury bond right now at 3%, potentially that could be a really good idea, and you might get some pretty nice appreciation on your bond if pretty much the bond price continues to go up, bond yield would continue to fall. So long story short, with all of this, let's just make this make sense. Investors are selling the 2-year bond, driving the rates up, just like if people sold a dividend stock, it would boost the dividend yield up, right? Very straightforward. The 10-year treasury, they're actually buying the 10-year treasury, and that is what is keeping the rates lower. And that is where you get the inverted yield curve. And it's telling you the Fed is going to make a policy mistake. That's the biggest thing. Now, as far as Q2 GDP, we still have the latest estimate at negative 1.2%. That last estimate was from July 8th. Tomorrow, we will get a new estimate once retail sales come out. Depending on what that is going to probably move the markets in a very substantial way. Would not surprise me to get a 1-2% upside move, 1-2% downside move over the next 1 or 2 trading days. You could see a pretty violent market reaction. Now, from going ahead into the future at this point, we've already established recession, while it's not good, it changes the narrative, right? If the economy is doing great, imagine a 2021 economy, but you got 9.1% inflation. Well, interest rates have to go up in a big way before you get to a recession, so these bond yields would just go crazy. Demand destruction, interest rates would be way too high, right? Once you go into that recession, you get that deflation, you get cheaper money, you get lower interest rates. It changes the dynamic though, because instead of worrying about interest rates and cost of capital, you now worry about how bad are company earnings going to be affected. And given where the markets are at right now, if we were to go into a recession quickly and inflation were to fall off a cliff, it might be plausible to say that a lot of stocks are at or under their fair valuations. That's a silver lining that you could get out of all of this. That does not mean potentially you couldn't flush out to the downside, you couldn't hit new 2022 lows, not what I'm saying. But it could mark a bottom sooner rather than later. So I do think right now is a great time to be buying, but you still want to be cautiously optimistic, and you want to pay attention to all of this data that I will personally bring you guys as soon as it comes out. And that is why you want to subscribe to the channel, you want to hit that like button, and you want to comment down below. Let me know what you think about all of this information. Now, before we go ahead and wrap up this video, let's go to the charts and let's see potentially what we could be looking at tomorrow if we get a low retail sales reading, which could actually be seen as a bullish thing. Believe it or not, it would pretty much solidify the fact we're not going to get a 1% rate hike. Retail sales, let's say they come in at negative 1%, no way we're getting a 1% rate hike. The markets will not price that in. Let's say retail sales are positive 1% for June. You're going to price in that 1% rate hike again. That's probably not going to be good. It's going to delay the bottom. It's going to delay a recession. It's going to delay deflation and cheaper capital. Now, I think up or down 2% tomorrow, very, very realistic. Up 2% from here would put the SPY at about 383.45 to end out the week. 2% down from here would put the SPY at about 368.17. The lows for 2022 is sitting at 362.17. So keep that in mind. I do think end of July, if you are going to see a flush out event, it's likely around that time. Just the week of expiration for July 29th. The same week you get advanced estimates for Q2 GDP. The same week that you get the Fed raising rates, 75 basis points or 1%. You also get 30% of the S&P that will report that week, including Apple, Microsoft, Google, Amazon, Tesla. Basically all of your $1 trillion companies will report during that time. So you're going to get earnings. You're going to get Fed. You're going to get advanced estimates for Q2 GDP. Depending on what that happens, end of July, you could very well see a bottom in August, potentially as far as midway through August if we do see a sell-off like event. But I think that right now is a good time to be a net buyer of assets, and that's exactly what I did today. Now, if we take a look at the MACD, we could see we've been pretty bullish on the MACD. We're starting to converge. When this yellow line goes under the blue line, that means you are now bearish. That's not good, right? And you're starting to head that way, but we're not quite there as of right now. If we go ahead and pull up the RSI, Relative Strength Index, you're at 41.28. So you're not even really even close to that neutral level of 50, and you're definitely not on the overbought side. If anything, you're starting to trend to the oversold side, and markets are continuing to rally, it looks like, into the last hour and a half of trading here. So that is pretty much going to be it for this video. Hit that like button and subscribe to the channel if you guys found value out of the video. Like I said, let me know down below in the comment section, what do you guys think about all this information? When do you think a bottom's going to be? Do you think we're close? Do you think we're not? What do you think about Fed Waller's comments? Let me know what you think about the stock market as of right now. No question, no opinion is invaluable, right? You can find value out of anything. So thank you guys for doing that. Get your free stock down below in the description as well with Webull, Moomoo, and Public. You guys enjoy the rest of your day, and I will see you in the next one.